Hello, my name is Alex Merced from alexmerced.com, and this is Finance in 5 Minutes. If you enjoy this, check out my podcast, Economics Why Not, on iTunes, Google Play, and Stitcher, and also go to learneconomicsnow.com. And if you ever need to learn more about finance to get a securities license like a Series 7 or Series 24, go check out Greco.com, Greico.com, for classes taught by me online. Now, finance. All finance is all about finding the money to do stuff with. So if you're a company, you're an individual, etc., we have a need to find money to satisfy investment goals, consumption goals, etc. So we got to figure out where that money comes from. There are two ways to finance something. You can finance something through equity, or you can finance it through debt. Now, if you've ever bought a pizza, you don't realize, but you've been doing financing a lot already. Because maybe you want to buy a pizza pie that's $20, but you only have $10 in your pocket. So you go to a friend of yours and you say, can we split the pizza? You pay $10, I pay $10, you get half the pizza, I get half the pizza. What you've just done is what's called equity financing. You sold ownership to raise the money that you needed. That's what companies do when they issue stock to the public. They're selling ownership in the company to raise the money they need. That's called equity financing. But sometimes you want the whole pizza for yourself. So instead of splitting the pizza with your friend, what you do is you borrow $10 from your friend. You borrow $10 from your friend, you take your $10, you have enough money to buy the pizza, and the pizza's all yours. But regardless of whether you enjoy the pizza, regardless if you drop the pizza on the floor and it's ruined, you still owe your friend those $10. So what you've done is you've raised the money through debt financing. Okay, you've borrowed the money you needed. That's what companies do when they issue bonds. Okay, and usually the difference between these two types of financing, again, is the difference between selling ownership or borrowing the money from the point of view of the person getting the financing, receiving the money. Now, the person on the other side is making an investment, and they're looking to make a return. And at the end of the day, it doesn't matter so much where they invest their money, how good an investment they make, they measure it in dollar terms and is in percentage terms on an annual basis. So if I make an 8% return, that means based on the money I invested, I have 8% more at the end of the year. So if I have an 8% return on a $100 investment, at the end of the year I'll have $108. Okay? So bottom line, as an investor, I'm weighing all these different debt and equity financing choices, these investments, to determine where I'm going to make the return that I want. Not all investors just want as much return as possible. Some investors basically want a moderate return to satisfy particular goals. But basically, there's different investments out there depending on your appetite for risk and your appetite for return. Okay, and there's that relationship, more risk, more reward. Generally, investments that provide you a higher return will always be at a higher risk. The reason for that is that if two investments had the same amount of risk, but this investment provided you a higher return, what would happen is that many investors would be like, I want that one. That one's better. So they're going to bid up the price. They're going to compete to invest in it. And they're going to drive up the price, and the more you invest, the less you're going to get out of it. Okay? Okay, so then what's going to happen is that they drive up the price, drive down the return until it matches. And everything with the same level of risk is generally going to have the same return. So if something promises you generally a higher return, it means it has a higher risk. So bottom line, when investors need more return, they need to take more risk. And that's part of sort of the game in investing. You're trying to figure out what's the return that you're trying to find within the risk that you're willing to take and where those two intersect. And then companies and other people who need to raise money need to figure out how to make sure that their investments are safe enough for your risk appetite and achieve enough return for your return appetite so you're willing to invest in their enterprises. And that's essentially finance in a nutshell.